Alrighty, my good people, what is happening? In this video, we are going to be going over the level 1 portion of FXE Academy. If you are currently a student of FXE Academy, then this video is perfect for you because this video will help you be able to pass the level 1 assessment so that you can move on to level 2, which is mastering the technical analysis. If you are not an FXE Academy student, that's also okay. I guess by you even taking part of this video gives you a little insight of what the students learn throughout the 5-level course of FXE Academy. Once again, FXE is just my educational brand, educational platform where I teach people on the day trading / Forex markets. But like I said in this video, we're going over level 1. Level 1 is the Forex basics and is essentially everything you need to know to be able to say you understand the basics of Forex. So for one, we have to start off with what is Forex. And Forex is the largest market in our world. And it's essentially the currency trading market. So if I just look up the Forex market, Google AI says the Forex market, also known the FX or the currency market, is a global, decentralized, or over-the-counter market for the trading of currencies. It is the largest and the most liquid financial market in the world with a day trading volume of trillions of dollars. Boom. Mind you, this is the basics. So if you didn't know this, then now you know and you understand the market that we are trading. Once again, we're trading currencies. Different currencies include stuff, of course, like the US dollar, the Great Britain pound, the Japanese yen, the euro, the Australian dollar, the Canadian dollar, the New Zealand dollar, yeah, all that stuff. That's what this market is. And like it says, it is the most liquid financial market in our world, meaning that it has so much money going through it, like it says, trillions of dollars, to where it's not even comparable to the other markets of our world. And look, it also tells about these currency pairs. So part of understanding level 1 is also understanding what currency pairs are. And it says that currencies are always traded in pairs. Remember that. They're always pairs, such as the Euro USD. The first currency is the base currency, and the second is the quote currency. And price reflects this based on the strength of the base or the quote currency. So for this Euro USD example, if at any given time the euro is stronger than the US dollar, then that currency pair's price will increase because that's the head of the currency. But let's say, for instance, the USD is stronger than the euro, then that currency pair, its price will decrease. Now, other currency pairs include things like, that was the Euro USD. You can trade the GBP JPY, which is the British pound compared to the Japanese yen. You could trade GBP USD, which is the British pound compared to the US dollar. You could trade USD CAD, the dollar to the Canadian dollar. It's so many things you can trade. The only thing I'll say about the currency pairs is that the JPY, the Japanese yen, is the only currency pair that is always a secondary. There's not one currency pair where the yen is the primary. So if you ever do want to trade the Japanese yen, you have to do USD JPY, or you have to do GBP JPY, or you have to do CAD JPY, etc., etc. Every other currency can be a secondary. So like the GBP can be a secondary, the USD can be a secondary, the Australian dollar can be a secondary, everything else. But those are currency pairs. Still talking about the basics. Now for the test, we don't really have to worry about, I guess it is good to understand actually that the market is open 24 hours, 5 days a week. So the market, this is the most liquid market and it's the most flexible. Like I say, day trading in the Forex market, it gives a person the most freedom to what they want to do. And like this 24/5 operation point kind of does hits at that, and then also the leverage. If you don't know what leverage means, it just means that you're able to make a lot of money with a little bit of capital within your trading account. So you can have like $100 trading account, and if your broker provides a high leverage, such as a 1 to 500 leverage, you can make that $100 flip. You can risk a large percent of that $100 and make that money really move for you if you take advantage of the right move in the market. But yeah, that's Forex for you guys. We don't have to read too much more literature. That's definitely the basics, and that's definitely a great introduction if you never knew what Forex was. Now, outside of that, there's price, there's structure, there's candlesticks for y'all see, right? So starting with price, right now we're looking at XAU USD, which is the price of gold. We're looking at gold, jewelry, you know that, right? To the right is the price. So gold is currently priced at $3,742 per ounce. It's been on a massive uptrend for a long time. Now, when I say uptrend, key term here, uptrend. When I say uptrend, all I mean is that price has been making structure points like this. And these structure points are called higher highs and higher low points. This is something you're going to have to know. This is the basics right here. If you don't understand what this uptrending or bullish, when I say things like uptrending, bullish, increasing, I mean this type of structure. And you can see this structure play out on the live charts, which is why gold has been going up, because it's maintaining this structure, right? Now, on the flip side of that is this bearish structure right here. So bearish structure looks something like this, what I'm going over with my mouse. And it's made of things called lower lows and lower highs. This is basic bearish market structure, or selling market structure, or downtrending market structure. All it means is that the overall trend is bearish, and you should be trying to execute some type of trades to continue this overall trend. So like right here on the current price of gold, price was uptrending, creating higher highs and higher lows. But then recently, price did break structure, and it's starting to move a little more bearish. One sec. So price broke structure here. So breaking structure is basically like a transition from an uptrend to a downtrend, or a downtrend to an uptrend. So price can go up, it can go down, and then it can break a higher low point right here, form that next lower high point, and break structure and flip. And then of course you can also do it on the opposite side, where price is going down, price breaks a lower high point, then we get a higher low point formed, then price continues to the upside. The breaker structure was here, price broke above it, it's a higher high, higher low, high, higher low, higher high, right? This is all market structure. Mind you, this is the basics. If you don't understand this, then you're not going to understand the rest of the levels. So right now on gold, of course, like people are anticipating a little more sales because of the lower high point that did get formed right here. We're anticipating price to go a little steeper right now, especially if you use that. Let me slow down now, because that's not the basics. Okay, so also the candlesticks are very important, right? Because the market structure kind of helps you, understand the trend of the market and where the market is going, and that's super important. Like you have to, before you even place a trade, you have to know, okay, well, what direction am I going to be trading? Like you can only buy or sell, so that's why that is important. But these candlesticks are also important too. So if we look at this blue candle right here, it's a blue candle. It's a bullish candle. Price increased with this blue candle right here. If you look at the candle and just look at its characteristics, it has the body. The body is the blue. The body is where price filled out. But then at the bottom and the top, candles also have things called wicks. Wicks. And all the wicks tell you within all candlesticks is that that's where price previously was. And I could show you a better example of this if I go down maybe on the 1 minute time frame. Okay, so this candle right here is live, right? That red candle was live and it's moving. And you see price currently forming wicks. It's wick. This candle has 1 second left. Boom, price just closed. And as you see, the wicks within that candle was telling you where price was previously at. All the body tells you within a bullish candle and a bearish candle is where price opened and closed at. So like on this red candle up here, price opened right here, and because it was a bearish candle, when it closed at a low. So that was the close of that red candle. On this candle right here, it opened up here. So it has 27 seconds left. So on this current red candle right here, we'll be able to see the candlestick open. We already know it opened right here. That's where it opened. We're going to see where it closes. And then we're also going to see where it was in the past. We got 10 seconds left. It's just filling out. This is a lot of sellers pressure right now we're seeing. It's creating a little wick. And there you go. It actually filled out the wick quite a lot. But in this situation here, price closed right there and then left a really small wick, which just really means that it didn't find it. It's full volume. So like these wicks tell a lot of stories, you know. They tell so much, you know. And when you see wicks, I just want you to think of wicks like a rejection. When you see a lot of wicks in a certain area, that just means that price is not trying to go either any higher or any further than that. So this example here is a whole lot of wicks, right, at the bottom of these candles. If you see stuff like that, that's a good indication to tell you that, okay, price might reverse from that area. And it did. Price started climbing from that area. You can find another example of this down here as well. You see a lot of wicks at the bottom. Price rejects, comes up. Even at the top up here, I see some wicks right here. Like that's why wicks are kind of important, because if you can execute at these wicks, you put yourself in a position to essentially buy or sell at these areas called supply or demand. So this is also part of quiz number 1, understanding what supply and demand is. And essentially, let me go on my 15-minute. All supply and demand is you understanding, okay, where sellers are at in the market and where buyers are at in the market. And when you identify an area within price where you see a lot of buyers place their orders in, that area is considered an area of demand. So a demand on gold that has been holding up that has held up very strong is this demand right here. Mind you, when price is at demand, you buy, because that's where buyers are at. The buyers I'm talking about is just simply shown in the price. So when price came down at first, we moved sideways at it, but then all these buyers came, right? That's buyers. People placed their buy orders at the demand, and price reacted off of that. If you look to the left again, price came back down to it again. It had a candle wick come inside of it, and then price increased. And then that's another example right here. Price came back to the same area of demand where buyers were at previously, and price increased. People take trades like this. I trade like this. I trade simple supply and demand. And yeah, it's actually really good. It's a really good strategy. Now, once again, it's not just demand, there's also supply. And supply is just you tracking where sellers are at in the market. So I see some supply up here. Mind you, it's where sellers are at. So when price first formed this area right here, you see price got pushed down. You see red candles all right here, and price started decreasing. Even right here, price came up into it and wicked it again and dropped. Like that's supply and demand essentially. Even up here, right? Like I see a little demand area right here, kinda. And of course, it's gonna take practice for your eyes to really like see all of this like the way I do. But that's why you just have to practice, go on trading view and do the same practices I'm doing. And all you're looking for is once again where price is, what area in price is price going up at, and what area in price is price falling at and rejecting that. So like this is clearly a supply up here, right? It's a supply because price came up to it. You got a lot of wicks, a whole lot of wicks. Remember, that's rejection. And every time price came to it, it sold, it sold, it sold. Price came back to it right here, it sold. Supply and demand, right? We'll dive deeper into supply and demand within level 2, but it is still part of the basics to understand it, or at least just its concept. I would say another part of the basics that we definitely have to discuss, which I should have discussed a little earlier, but I guess it's the trading sessions that the market has available for you to trade. So there are 4 main sessions that these currencies move the most within. And those 4 sessions are listed right here. So you have the Sydney session, which runs from about, what's that say, 5 p.m. to 2 a.m. You got the Tokyo session, which runs from 8 p.m. to 4 p.m. You got the London session, which runs from 3 p.m. to 12 p.m. Then you got the New York session, which is the most commonly known one, which trades from 8 p.m. to 5 p.m. Now look, mind you, we're trading currencies in this market. These sessions are named after different type of countries that hold different type of currencies. So when the Sydney session is live, for example, all Australian dollar and New Zealand dollar currency pairs are going to see the most movement. When you're trading within Tokyo session, all Japanese yen pairs will see the most movement. When you are trading during the London session, all Great British Pound and Euro pairs will see the most volatility and movement. And of course, when you're trading during the New York session, all USD pairs will move, all Canadian dollar pairs will move. And honestly, so let me also say this, right? The London session and the New York session are the top 2 most volatile times to trade the market. I always say it's a good time. Anytime from 12 a.m. to 12 p.m. is a great time to trade because of these 2 high volatility sessions. And this little cross right here in time from like 8 a.m. like this overlapping time between London session and New York session is honestly the best times to trade because you're getting 2 session volumes in one period of time. And that's just important when you want to see price move and when you are in the market that your position is actually pumping and you're actually seeing a good profit. So if you do decide to trade, which you have to ask yourself this, like you have to ask yourself after seeing this, okay, well, what time period am I going to be topping on the charts? You know, like the market is open 24 hours a day as you see, but you don't want to be trading all 24 hours. I like to say if you're going to be an intraday trader, which is what I am, hey, key term, intraday trader. This is transitioning over to the 3 different types of traders there are. So an intraday trader is a person that's trading the market for about 1 to 4 hours in a day. You feel me? We just on the charts, day trading literally. If you're a scalper, you are not in the market for no more than like 15 to 30 minutes at a time. Like a scalper is a person who's in and out the market. They might be trading on the 1 minute time frame and just taking advantage of quick movements like that. Scalper. And if you're a swing trader, you're playing the market out for the long-term move. So you might be in the market for a couple days, you might be in the market for a couple weeks, whatever, but you're holding the market for a long time. And me, like I say, I'm an intraday trader, and I trade usually between 7 a.m. to 11 a.m. So I'm falling right between that perfect sweet spot. And yeah, you just want to ask yourself, what if you're going to be an intraday trader, what 4 hours of time are you going to dedicate to just say, hey, like, all right, this is my trading time. You feel me? But those are the sessions. Definitely ask yourself that. And I'm trying to think if there's anything else. Um, there is one more thing. It's really just about like market execution, right? So like if you're watching this video, hopefully you are signed up with liquid brokers and you do have an account made with liquid brokers. And it was just really about what's the process when it comes to actually buying and selling. So when you're buying and selling and you're actually like placing your trades on the liquid charts app, it's not that, oh, you just find a position. Like say if you're just, this is level one, right? So you don't know all the stuff. But say if you just want to place a trade and you see the market is at a nice point like this, and you're at a higher low point. And you're like, hey, I want to buy. Like I know about higher highs and higher lows now, and I want to buy at a higher low so I could, enjoy the profit from the buy. Because remember, like when you're trading market structure, you're buying low. You're buying at the higher low. And when you're selling the market in a bearish market structure, you're selling at the lower high. Because it wouldn't make sense to sell when price is low. It wouldn't make sense to buy when price is high. So that's why, once again, you're buying at the higher low in this example. So say you do that, say you hit the buy on the liquid charts app. Let me log into my liquid charts app real quick. I know mine looks a little different, but it's essentially the same thing. I'm not going to lie to you. You got your sell button, your buy button, and you want to buy. So you would hit the buy button, and as soon as you hit buy, you want to do something called set your stop loss. A stop loss is essentially something that protects your order from, it's essentially your risk management, right? So if I put a trade at the same high low point right here, this is a buy position tool, and it just shows me what prices look like when I'm in a buy. So my stop loss is this red area, and all it's saying is that once price comes down to that price point, close me out of the trade and just close my trade. Once again, your stop loss is your risk management. It's your safety net. You have to set a stop loss as soon as you enter, right? And then your take profit is of course like, it's the same thing, but in vice versa when you're in profit. So once price hits a certain point, your trader will automatically take out your position. You'll be out the market. Okay, so if we go back to the liquid charts real quick, there's also something called a lot size. Your lot size is this number right here. You can adjust this in many different ways and change the number to many different things. But all it is your money multiplier. So the higher your lot size, the more money you're risking per pip. And it's essentially like, it's essentially the number of pips times your lot size equals your profit or loss. Now you might be asking yourself, okay, well, what's a pip? A pip is just price. So when price moves, like just using this tool right here, this 15 right here is the pips. 14 pips a price, 5 pips in price. So if you're risking 5 pips and you're trading on a 0.01 lot size, you're risking X amount of dollars, right? Now, honestly, I don't even like calculate my risk, my lot size anymore. I use an app. I use a mobile app called Stenu. Looks like this. It looks something like this. It's a lot size position calculator tool. So literally all I have to do is put in my account balance at the top. See, I do 10,000. And for the risk, say I want to risk like 5% of my account, I do 5%. And then my stop loss is the pips. Say I want to risk about like 20 pips, I type that in there. Then after that, I have this option to pick, okay, well, what currency pair am I trading? And I'm trading gold, so I do XAU USD. And then it'll literally give me a full list of lot sizes. It's kind of hard to see, but it's giving me a whole list of lot sizes I could use, long story short, so that when I'm going to place my trade, I don't even have to do the math calculations. I could just be like, all right, this is my lot size. I type it in here, hit buy or sell. Then I set my stop loss, take profits, whatever, But definitely test it out. You should have a demo account already set up. Depending on the size of your demo account, that should depend on like how high your lot size goes, of course. But just really trying to think if I hit everything. But I really think I hit everything in terms of the basics. The main takeaways being the market structure, understanding what bullish and bearish market structure is, understanding what supply and demand is, understanding what the currency pairs are, understanding the different type of currencies in our world. You want to understand the four different type of currency sessions that you can trade within. And then of course you also want to understand just a little bit of what it looks like to enter in and out the market. So of course, like stop loss, take profit, the pips, the lot size, that type of stuff. And yeah, that's level one. I mean, once again, this is the basics, guys. You know, if you don't understand this, you're not going to understand everything we talk about moving forward, because it's just certain principles that you got to follow in the market, and this is that. So leave me a like if you guys enjoyed, and I'll catch you guys in the level 2 breakdown. Peace.